Welcome to Hit the Brakes, where we dive into the top stories, market trends, and ins and outs of the supply chain. No matter if you're tuning in from the cab of your truck, behind your desk, or on your daily commute, we're glad you're here and we're ready to serve you. Let's get this show on the road. This is the last episode of our three-part series from the Freight Forecast. In this episode, we talk about what the 2024 market trends really mean for you. In case you missed it, part 1 and part 2 will be linked in the show notes. Where are we headed?
Where are we headed?
I think that's this is all leading up to this graphic right here, and just to set it up, the biggest graph we see on the left here is an aggregate spot rate across all modes, a graph depicting that, and we also see intermodal and then contract rates in the bottom right there. So Tim, can you kind of just elaborate a little bit on how all three of these may tie together, and really where are we right now? What can move this graph out to the left or right? Some things maybe to keep an eye on, and then after we've let's give ourselves 5 minutes or so to maybe talk about these slides, and then we'll take some questions.
Sounds good. We definitely set it up right in terms of that spot rate is sort of it's sort of the middle, and I see a question coming in. Has the spot market hit bottom? And that is the question. If you look just at our forecast, the answer is yes. October in seasonally adjusted terms was the bottom if our forecast is right, and we do expect rates to drop here from January into February with sort of normal seasonality, even a little bit worse than seasonality, because we've had a little bit above normal seasonality around the holidays that we expect to sort of fade a little bit in February, but here's the sort of where the rubber hits the road is sort of right now, and we think certainly seasonally speaking, things are going to be soft for the next few months. That's just totally normal. But at the margin, we are unfortunately still adding some capacity when we look at those new truck sales. And to maybe go back to Brett's question a second ago, the other place where drivers are going is those big private fleets, and private fleets are still adding a little bit of capacity at the margin, and that's really our risk. The biggest risk to this forecast is if we get a surge of truck orders that we're not expecting. That backlog at the moment gets us through Q1 at pretty elevated production rates, but not much further than that. So we think there's a pretty significant change coming there, but we could be wrong. There could be a lot of private fleet orders, and they could still want to continue to grow, and that would probably push this downturn out even further into the future. We think that's very unlikely. Obviously, that's not our base case, but that's the way to think about how truck orders will impact the industry. To go back to your question, Mitchell, about how these are tied together, really the spot rate is the center of the industry, if you will, from a forecasting perspective, because it's such a great daily leading indicator. And so our forecast for truckload contract rates and intermodal spot rates are very closely tied to our truckload spot rate forecasts. And we kind of believe that if you can understand the truckload spot market well, you can get a lot of other things right in transportation. And with relative ease, but getting the truckload spot market right is not the easiest thing in the world, of course. So what's the justification for these higher rates? I mean, it's what we just went through. I mean, the big question is when we find that balance and things start to move up. I think there's lots of evidence that we're very close. You can see that spot rates have been essentially unchanged since the second quarter of last year. And so that stability says a lot to me in itself, that we essentially couldn't go lower. We had sort of hit marginal cost, if you will. I think we're below cost for any reasonable costs. But now things are starting to turn, and we've already been through a long downturn from a historical perspective. If we're right that October of last year was the bottom, it would still mark a 20-month downturn. which is 4 or 5 months longer than the prior 3 on average. So we've already been through a long downturn. So just from a historical perspective, that's a little bit more evidence. But really, as we look forward, it comes down to what's going to happen with those supply and demand factors we've already kind of talked through, and we think those both move in favor of higher rates.
I think the other interesting thing that's going to be interesting to see this in the coming year is just the local disruptions and changes in spot rates, especially as we're talking about capacity or the containers landing on the West Coast as opposed to the East Coast, and see how those may, even though we're looking at an aggregate forecast that I think we all have to keep in mind that just because, you know, we're forecasting a turn in the spot market or year-over-year inflationary market in the next quarter or two, doesn't necessarily mean that's going to happen in your region, and it may be greater in one region than the next. So that's going to be neat to see to watch unfold in the coming year. So just another thing to call out.
I think that's a great point. I think that east to west shift is going to be a big theme of this year in a huge way. We've already seen spot rates for intermodal off the West Coast increase considerably back in September, October of last year. They haven't really moved up too much since. There's 20-25% moves though back then, and that was, you know, during peak season, and so they've held those gains, I guess, into January, and I guess that does, you know, is a bit better than seasonality. But as you said, that's just off the West Coast, and most of the intermodal network is not feeling much tightness at all, and the East Coast is certainly going to be at a disadvantage.
Yeah, great. Well, that's a lot of fun. So let's go ahead and move into taking some questions from the attendees. Let me get, you know, just a reminder to everyone, please just submit your questions in the chat. I'm not using the chat, but very first question we have here. Let's see, what can we expect to see now that shippers are slowly rerouting their imports from the East back over to the West Coast? I think we've kind of already, you know, actually, ironically, already touched on that one. So, give me 1 second. Let's find something new here. Let's see. You know, okay, here we've got one right here. So, any thoughts on private fleets, advantages versus disadvantages? I guess, you know, that's probably one of those things that depends on what market we're in, and you know, but Tim, I'll pose that to you. What are your thoughts on private fleets in general, advantages and disadvantages of each?
Yeah, that's a great question, and we are actually, I'm going through the MCMIS database from the FMCSA to try to parse out exactly, you know, which trucks are private versus for hire, and I'll get back to you soon with answers on that. But we think it's roughly 50-50 when we think about Class 8 tractors. Certainly more of the day cabs are in private fleet operations, and sleepers if we're in the for hire market, just in general terms. But when we think about the advantages of owning your own equipment, you know, for a retailer, if you're already using a lot of for hire truckload, you know, fleet capacity, there's certainly advantages to bringing some of that in-house. Having control of your supply chain increases. You know, there's a lot more, you know, flexibility of how you use that vehicle. It's there's also, you know, risks and costs involved, and we think that the for hire market at the moment is something like $1 per mile cheaper than private fleets.
Wow.
And that's not even the spot market. I'm just talking about contract.
Okay.
Because private fleets are just inherently less productive. There's going to be a lot more empty miles. They're not filling their backhauls most of the time. Some of them do enter the for hire market and pick up backhauls and you know, reduce their deadhead. But deadhead, you know, in the for hire sector is something like 10-15% versus probably 40% plus in private fleets. So that kind of puts them at an inherent cost disadvantage. And in general, you know, on top of that, they tend to pay their drivers, you know, on average a good bit more. So it's a pretty significant cost disadvantage. Now you're buying yourself resilience, flexibility, you know, those kinds of things are important, obviously, these days. And I understand why the industry's been, you know, doing that for the past couple of years in a pretty big way in terms of rebuilding that. But you know, at some point, cost economics start to matter more.
Right.
Yeah, Tim, it seems like this is maybe a trend of kind of opportunism You mentioned resilience and some of the strategies that might be driving this, but you think about the for hire, driver availability. You've got drivers that are potentially looking for jobs as they, maybe set aside their authorities. One other interesting thing I just want to call out quickly is, ACT Research reports on used truck prices from dealers, which I thought that was a very insightful graphic with some good statistics that, kind of right before the rates peaked or right around that time in 2022, a used truck with 4 years old, almost 500,000 miles on it was going for $140,000 at the peak. And now fast forward to today, there's been this dramatic slide that's kind of mirrored what we've seen in the spot market, down to about $60,000, kind of down to, I guess we'd call it more normal levels, pre-pandemic. That is this providing just kind of a fruitful opportunity for shippers who wanted to go after a strategy. Maybe they were burned during COVID, wanted to invest more in that resilient owned capacity. Are some of these factors just proving to be a very fruitful opportunity for shippers to even go after this?
Well, yeah, I mean, I don't think a lot of shippers are going to be buying a lot of used trucks, if that's what you mean. I think they're going to be out of that market and then typically buying new equipment. And I think it really is the owner operators who are going to be going after the used trucks. They have come down quite a bit, and at these rates, it's hard to justify. I mean, you do hear about people going out and starting their own trucking company. Even today, it happens, but not many. And actually, one of the really interesting sort of changes in trend, not to go back to that DOT operating authorities. In the latest month, when things got worse, it wasn't necessarily the revocations that got worse. Those stayed at similar levels. It was the net worsened because fewer people came into the industry, and so that was interesting. There's always going to be new entrants, and some of that's seasonal. But the point is, it's very tough, and I think used truck prices are a great. Are a great sort of following indicator behind spot rates, and that kind of suggests that we haven't quite found the bottom yet, on those.
Great. Okay. I've got another question here. This is continuing a little bit similar to what we've already discussed, but you mentioned Class 8 truck orders are down. Can you elaborate on why the private fleets are expanding?
Yeah, some of it's timing, right? Like the expansion is sort of all the trucks that were ordered a year ago, maybe, and that a lot of those orders came in when things were extremely supply constrained, and a lot of what's happened over the past year is just taking delivery of that. Now, looking forward, the orders are down, and so they're not doing that as much, and so that tells us that 24 is going to be different from what we saw last year, and that's the good news. Is not that different, and we're not suggesting a sharp downturn in truck production, but going back from adding capacity to the fleet to taking a little bit out this year.
AB5. Okay, so any thoughts on the effects of AB5 on the truckload employment numbers from the BLS?
Honestly, I'm not sure I know the answer to that.
Okay, I'm not quite sure of the impact it might have, but I'll point out another thought here on the BLS. We talked earlier, lowest jobless claims report since, and this is kind of shifting a little bit, but still with the BLS, lowest jobless claims report. This came out this morning since September of 22. What impact do we think that may have on volumes even in the coming year or next 18 months even?
Yeah, it's a good question. I touched on it maybe a little bit earlier, but I think it just generally tells you that it's a strong economy with a strong labor market. If we've got low claims, that means we've got a lot of jobs being added. If that means GDP is growing, there's more consumption happening.
It's hard to get those three. It's hard to count on those 3 rate cuts if we continue having jobless claims like we're seeing right now. But then again, it's a strong market. Maybe we don't need it. So
yeah, it's for a good reason, right? Like
right, yeah.
Yeah, so I think it's a good news thing. I think the piece of caution to keep in mind, of course, is if wage inflation gets out of control and we get too tight, that could be inflationary again. And not only maybe things get bad, we could start talking about rate increases again. I'm not suggesting that's a likely event, but that's the direction that could go if things are too strong. I think it's mostly a good news, kind of a, I don't want to use the term Goldilocks because again there are inflation risks, but it's a good news thing.
Great. Now, for both of you guys, and on this next question, fuel. Any insights on fuel forecast and the effect it will have on 2024 and 2025?
I can jump on this. We've been sharpening our fuel forecasting a little bit here. We actually recently hired a economist from General Motors who spent decades forecasting currencies and commodities there. So we're amping up our firepower there.
Great.
What I would say is that one of the things that is happening. I mean, there's obviously a lot of oil price risk right now with everything going on in the Middle East. You would think oil prices would be a lot higher than they are right now, but certainly, we're on one side of the Arabian Peninsula with the violence, not the other. If things go over the Strait of Hormuz, where about a quarter of the world's oil production travels through, that's going to change fast.
Yeah.
So that's the big sort of risk in my mind at the moment. But overall, oil production is, domestic oil production here is at very healthy levels, and electrification of light vehicles around the world is gaining some pace, and so that's taken a little bit away from oil demand. And meanwhile, you got OPEC who's losing members. I think it was Angola who left recently, and so a little bit less cartel power maybe, and so we're sitting at West Texas around $72, I think, at the moment, which is a pretty low price for given all that's going on in the world. And so so generally that's good news from and that certainly has been helping the inflation picture. Some of it lately is probably seasonality too. I mean, it's not the biggest driving season right now, so things certainly could change as the year picks, as we go through 2024. Seasonally prices do tend to rise in the summertime, and if we have further conflict related risks playing out, then you could certainly see this situation change, but at the moment it's pretty benign.
Yeah, I just want to add some context from the freight standpoint, just with oil markets. But you go back to the last major recession, 08, 09, diesel prices actually spiked as the economy was slowing down, and it led to historic number of bankruptcies in the trucking sector, just wiped them out. We've seen a little bit of the opposite. We did experience some really high diesel prices at the onset of the Ukraine war, but really, as the freight market has turned and rates have come down, diesel prices have also come down from some relatively historic highs at the same time, that I think actually helped drag out this downswing a little bit longer. You mentioned this, Tim. It's longer than average for this point in the cycle. So, diesel prices come down was a tailwind for trucking firms on their operating expenses, allowed them to absorb a lot more of the revenue hits for a longer duration. So I think that's one factor we have to kind of keep in mind as we went through this, is that we did have a couple different levers, kind of being pulled that were impacting this, but oil prices actually have served as sort of a tailwind to keep a lot of these trucking firms afloat during this.
Yeah, I think that's fair. And while you want your carriers to make it through, like, we also want capacity to contract. It's one of those tough, awkward things. But I think you're absolutely right.
I think the other big difference between the 08, 09 or prior recessions or market turns would be just domestic production. It is the highest numbers we've ever had, and we continue to add additional wells every month domestically. So I think it just insulates us a little bit more than we've ever seen in the past 20, 30 years at least from geopolitical tensions and how that may spike oil prices. Just acts a little bit different. Or some of those events have a little bit of a muted impact on the market than it would have had 5 or 10 years ago.
Yeah, actually, that's probably the biggest upside risk to oil prices, Mitchell, is if these low prices sort of disincentivize that strong production we've got going on here. I think you're exactly
That's true.
right.
No.
Yeah.
Okay. So I think we have time for one last question here. Let me read it here. Okay. So, sorry. Let's see. All right. So we're seeing more and more reports of the southern border closures and delays. With Mexico now the top U.S. trade partner, are there any freight-related predictions in regards to that ongoing issue?
Of nearshoring, yeah, that's a great. It's piece. We didn't really talk about it as part of our freight volume forecast earlier, but it's definitely a piece of that puzzle. When we get to sort of robust growth later this year into next year, we expect a pretty strong industrial economy. There's so many projects. There's more billion-dollar projects starting, going on and starting in the near term, pretty much than ever before in this country, from not just in Mexico, though, in the U.S., and it's definitely going to feed on itself. I think you've got a lot of companies building here, but you've got a major shift down in Mexico. The peso it's the only currency in the world stronger than the dollar, and it's a lot stronger. So there's massive investment going into Mexico, and it doesn't look like that's going to end anytime soon. Certainly, it's not just U.S. companies. There's a lot of different companies that are investing in Mexico right now. So it's a fascinating piece of the freight puzzle. I do think the industrial cycle over the next few years for the North American economy is going to be broadly positive. Cross-border volumes are not growing like you might expect at the moment. They're kind of flattish year over year, but after some really strong growth the last couple of years. But I think that's going to continue to trend higher.
Great.
Yeah, Tim, I think one thing that was really interesting too is, Mexico also is the top export partner when it comes to Class 8 trucks, kind of bringing it back to the trucking equipment market. I think that's a very interesting dynamic. You think about all of the de-risking or decoupling from, Asian-based supply chains, Chinese-based supply chains, nearshoring to Mexico. You're seeing a lot of that investment, and you're kind of talking about that. I think that's just another interesting component of this, given just the intricate nature of our two countries and our kind of a joint economy, on some of that front. I think that's really interesting. I do want to make one comment that as we see these volumes pick up from a U.S. surface transportation standpoint, a lot of those border crossing markets will experience some tightening. You'll also see a lot of these carriers chase the volume, chase the rates. So I would expect a lot of carrier networks to also kind of prepare for some of these volume changes, the West Coast, cross-border from Mexico, and see a lot of these units start to reposition to capture the rewards that come with that volume.
I think that's very fair.
Great.
Yeah.
All right. Well, thank you. As we're coming to the end of our time, unfortunately, I think we could do another hour if we wanted to, especially with this Q&A format. I think everyone enjoys it. I hope everyone listening has enjoyed it as well. But Tim, thank you for joining us. Very helpful, very informative. I know there were a lot of questions that we weren't able to get to, unfortunately. So I want to, when we have those, and we'll try to follow up with you guys and answer them the best that we can. We also, just to point out, I have my email on here, my cell phone number. I love talking about these things. So if anyone cares to reach out and talk further, call me, text me. You have my phone number. Don't hesitate to reach out. Thanks for joining us on Hit the Brakes podcast. Want to know more about today's episode? Visit fetchfreight.com to connect with someone from our team, get a quote, join our carrier network, and more. Check out the show notes below for specific links mentioned in the episode.